Hey guys, my name is Ruben. In this video, I'm going to talk about going to buy in the money, at the money, or out of the money calls. It's a really common question. I kind of get it all the time, and it's a really valid one. And if you don't know what a call is, essentially it is the right to buy a call or the right to buy a stock at any particular price. So I'm only going to talk about buying calls, right? So three big the three big questions, right, when it comes to buying a call is the strike price to buy in the money, at the money, or out of the money. So today I cashed out my TD Ameritrade calls, and I bought them mid October for 83 cents, and I cashed them out today at 10.10, and some of them at $9.70, and I'll post those receipts here in a little bit. But so I'm going to go over the advantage of each one based on my personal experience, why I never buy in the money calls, again, based on my style and what I look for when I'm buying a call. So nothing I say is a buy, sell, or hold recommendation. You can lose all or more of your capital whenever you are buying or selling any asset class or any stocks, futures, forex options. So it involves a lot of risk. So this is simply my opinion for entertainment purposes only. So the big advantage of buying in the money calls that a lot of people say is that the in the money calls has the most intrinsic value. It has the most to so let's say that a stock is $100. If you buy the call that is $90 and you spend $15 on that call 3 months out, essentially 10 of those dollars are worth something. They have intrinsic value. And then the other five are you're paying for time decay and so on and so forth. The other one would be at the money, which is right around the current price. And so most of it at that point will probably be extrinsic value. And then the far out of the money would be the strike that is above current price. So the reason why I personally never buy in the money calls is because I trade with the outcome in mind. And for me, the way you trade anything, right? And even as an options trader, I usually trade directionally to some degree. So if I'm trading to hit a target of $120 and the stock is currently at $100 and my stop is $95, well, if I buy, theoretically speaking, more times than not, if I buy the in the money call, let's say the $90 call at $15 with $5 of extrinsic value, if it pulls back to where my stop would be, at this point, most of in the money call just became fat, right? So if you're eating a piece of steak, it just became a lot of fat because on the pullback, you actually, from my experience, end up losing the most money whenever you are buying an in the money call. I'm also supply and demand trader. So to me, other than trading non-directionally, so an iron condor, you're going to trade directionally. So you're either going to get stopped out on your trade or you're going to hit your target more times out of not. So with that outcome in mind, in the money calls would probably lose you the most money if you are wrong. In addition, trading stocks in the US gives you a 2-to-1 leverage to a 4-to-1 leverage, depending on your account size. So it could be said that in the money call gives you about 8-to-1 to 10-to-1 leverage. So you're theoretically speaking expanding and doubling your leverage with a in the money call versus using just your marginable amount to buy the stock outright. So to me, then the second question is, well, how much of the position are you loading up that you feel they need to buy an in the money call versus just using your margin to buy the stock with the 4-to-1 or even 2-to-1? At that point, then it becomes kind of a position size question, an opportunity cost question as to why even do that in the first place. The next one would be at the money. So what I like about at the money is that, in my opinion, if you're a little newer, then you're kind of just essentially paying for the leverage. And the advantage of buying calls across the board is that a stock can always go to zero. So can a call, but then it's very different to have $100 stock go to zero than it is to have a call that you paid $500 for, or even $1,500 in the money going to zero, right? You're only losing $1,500. So it protects you from overnight risk because you'll never lose more than the value of the call. So from that standpoint, you are paying for the leverage at the money, but you're also not going to wake up one morning with the stock 50% lower and losing more than what you paid for the call. So from that standpoint, I like it. I always usually go 3 months out minimum whenever I'm doing any kind of options trade because I can always I can always sell it a close early or buy it a close early if I'm selling a vertical put. So then the last one would be the out of the money. So that means that if the stock is currently trading at $100, I'm expecting it to go to 120. That means I buy the maybe 110 call, and then that one is probably going to be really really cheap, maybe like a dollar or two. But then if I was going to spend those original $1,500 on the in the money call for the same trade, I can then probably buy like 7 of at the money and maybe even like 10 of out of the money. So then that means that or 15. So if it's a dollar to buy the out of the money 110 strike, then that means I can theoretically buy 15 or so for the same risk. But let's cut that into a third of that, because let's say that you can always sell or close the in the money option early. And by doing that, you just let's say you don't lose the entire value of the option because you bought it 3 months out. So you still have time value and what have you. So then let's say I buy 5 of the 110 strike, all being roughly, let's say, a $500 to $1,000 risk. And let's say 500, let's say a $500 risk. So you couldn't buy the in the money. So then so I guess I'll do 1,500. So you buy that in the money at 1,500. You buy one of those, 5 of at the money at 100 and at right at the 100 strike, and then 15 of the 110. Well, if the stock hits your target, the 110 at 15 contracts that you paid for a dollar, that one is worth at least 9 now. So then your risk reward just became a 10 to 1 per contract that you buy, assuming that you expect to lose the entire value of the call. Whereas to the original in the money, the new value would be 15, it might be 2,500. So then on the first one, that in my opinion, the in the money, that in my opinion has the most risk because a pullback, it's going to become all fat of the stake, just lost the most money and had the least reward. The at the money, let's say you buy 3 of that one, made you roughly, that one probably give you like a 7 or 8 to 1. Whereas so the out of the money became now your most profitable. So being the $100, if you buy 3 at the $100, you made $3,000. If you bought 10 of the a 110 strike, you made roughly 10,000. So in my TD Ameritrade trade, I bought the $40 strike at 83 cents when it had a aggressive pullback to 33 something dollars. The reason I did that is usually whenever there's a strong pullback, the algorithms or whoever are the market makers, especially with the call side on out of the money and even at the money, they have an aggressive because they pull their orders, or so it seems. They have an aggressive drop in price. So at that point, I always buy the at the money or out of the money in between supply and demand, right? So I think a lot of the challenge that people have is that they want to buy really, really cheap calls far out of the money, like it's a lottery ticket. And theoretically speaking, that's never going to happen. The caveat for me, or what I do to get really, really cheap, so I got a roughly at least a 10 to 1 in like a month and a half. So what I do to offset that is I'll have a supply and demand alarm on some of my favorites, usually tech and stocks. I really don't trade indexes. There's a lot of reason why I hardly trade indexes when it comes to options. I'm not against them. They outperform the market usually far. Last I read, just following the SPY ETF will outperform 95% of brokers and managers and what have you. But in my opinion, what's the point of being such a good trader in different asset classes if you're just going to trade the indexes, right? And another reason I don't trade the indexes is because it doesn't give you a ton of free money because they are so saturated. Um, so my rule for that is to get a really cheap call is whenever there is an aggressive pullback in something that I already have an alarm on, I immediately go, if it's not a tech stock, because the tech stocks I feel like are the caveat. I usually sell vertical puts on tech stocks because that is, I think, the best thing to do for that sector, in my opinion, my experience, based on my style. And so whenever that happens, in like not so a lot of like the Starbucks, those like large cap kind of stocks, whenever they have TD Ameritrade, whenever they have an aggressive pullback, all of the orders get pulled out of the options chain. So then they become very, very cheap. So then I find them in between supply and demand, and I usually go 3 times out my expected return. So if I'm expecting the stock to hit target based on average, whatever, average to range, whatever you use, I will usually go 3 times that to give myself room to be right. So if I'm expecting based on whatever indicator or whatever you use, I don't use indicators, to for that move to happen within the month, I will buy the call for 3 months out. That's just a rule. I always go 3 times expected arrival when it comes to that. So today, the 3 calls that I had left for TD Ameritrade, and I guess I'll do the insert of my screen. I bought them for 83 cents. I had 3 left, so today I made $2,085 based on that. In under a month, I got a 10-to-1 on those. So you can do a 10-to-1 on a lot of things on Forex futures options. I like options because I have the option to take profits early, and I have the ability to not be stopped out in an options trade, meaning if any stock, futures, or whatever goes beneath my stop and I have a call, this is another thing. The out of the money call will not be as affected, or at the money call as affected. Again, like I said, with as the in the money call will be. So the out the money strike or out of the money strike is going to be very mildly affected by violent moves over. So especially this is a great example actually, because especially with like earnings or in this market condition where we don't know how high the market's going to go and there might be a huge pullback out of the money, you can position size them to be equivalent to your portfolio if you were following the index, and you are going to at least either be wrong for a very small fraction of what would cause you to be wrong with in the money calls or buying it outright. And if you're right, you're going to keep on taking the profits. Not to mention that at the money or out of the money, as you are correct, the value of the call becomes exponentially larger. Whereas to in the money, you're maybe getting like a 3.3 delta. With that being said, I always follow supply and demand and break evens, right? So I hardly even look at the Greeks. So I do all the math in my head. So if a stock is at $100, at 100, demand of a stock is at $100, is trading at 105, and my target is 120, then whenever any move happens, if my target is 120, I know based on the strike how much that's going to be when it hits my target. So I know that the 110 out of the money call will be worth at least $10. So if it's 83 cents and that my target is going to be $10, then that's going to be at least a 10-to-1. My in the money doesn't really accrue. You eventually get a 1-to-1, which, again, my opinion, my perspective, allegedly, what's the point? I might as well just buy the stock outright. Like, I don't see the point of buying. I really, I've gone about it in my head over and over and over again. I cannot see a single reason why I or anybody else would want to buy an in the money call. I really can't. And I'm not saying that that they're wrong. I'm just saying I don't see why. The reason why I feel like they're there is because a lot of hedge funds, banks, institutions, as they want to get into a stock or anything like that, they have to use different strike prices because they cannot buy all of the contracts of the out the money or out of the money call. There's not enough. So they have to position size at different strikes to be able to move, and then they know what their delta is upon a certain move, I imagine. But other than that, for an average, like for an everyday trader, I really don't see the point. If you love them and you understand why you do them, please let me know in the comments below, because I'm not saying they're wrong. I'm just saying for me, I never quite understood what the point of doing that was. And then so then that leaves us with at the money or far out of the money. The biggest risk I find with both of those is not a trading risk, but rather a personality risk. I am concerned that people, because they are so cheap, they're just going to load up and then they will expire worthless. That's why for me, I still take kind of the stock risk reward or the stock position size or the in the money option position size to do that with at the money or out of the money. just to keep myself in check more than anything else. So I would do a screenshot of kind of my trade today, but I would have to edit that in. So I'm probably gonna do another video later. Um, but yeah, so I sold them. I bought the TD Ameritrade calls for 83 cents. They were a 10-10, and then that's another thing, and then I'll have a stop loss on the option contract itself, right? So once once it came to target for me and it got more than a 10-1, a 10-10, I put a 10-1 would have been a 83, but once it hit 10-10, I put a stop on the option itself, and they ended up getting filled at $9.40, giving me about like 11 or 12 to 1 on the trade in about a month or so with very minimal risk. So I hope the video was helpful, guys. Let me know in the comments below, and I'll probably do a full video with the edits and the inserts and all that, explaining my whole train of thought. Also, if you like this video or this channel, feel free to subscribe. I will not go over supply and demand trading. I work on online trading academy. However, if you are in the LA area, if you go to the Trading Academy campus in Westwood, let me know, and I'll see you there because it's down the street for me, and I love everyone there. Or if you want to go to a PTW or anything like that in the Westwood area, let me know. And then I can come hopefully say hi to you when you're in the campus. Other than that, like, comment, subscribe. And then if you want to see more of my what moves me and what got me here and how I love the markets and how I feel like, they're the ultimate depiction of where we are mentally, emotionally, and conscientiously, follow my 5D by Ruben Landon Dante channel. And that is more of a metaphysical channel, which is really my passion. And I feel like this is as within the markets are so without. So with that being said, guys, love and light. Thank you for watching, and I will see you guys next time.